Have you been wondering how the US economy has been performing recently? Well, let's crunch the numbers. The final quarter of last year saw a gross domestic product growth of 3.3%, adjusted for inflation. Yes, you heard it right, 3.3%. This might seem like a slowdown from the previous quarter, but hold on to your hats because this figure has exceeded economist expectations by more than a percentage point. Now let's talk about inflation. A core price increase, which excludes volatile food and energy costs, rose by 1.9% in the latest quarter. That's right in line with the Federal Reserve's target inflation rate. So what does all this mean? The US economy, it seems, is on track for a soft landing. We're talking about a scenario where price increases return to normal levels while the economy continues to grow. So, despite the slowdown, the economy has performed better than expected, causing a surge of optimism. What has contributed to this economic growth, you may ask? Well, let's dive in. The economic growth experienced in the last quarter of the previous year was primarily driven by an increase in consumer spending. Now, consumer spending is pretty significant because it accounts for about 2/3 of US economic activity. So when consumers are spending, the economy is humming. But that's not all. Businesses also played a big part. They ramped up their spending on inventory, indicating a confidence in future returns. This private sector confidence is a positive sign of steady economic growth. And let's not forget the role of state and local government spending. This spending, particularly on infrastructure, has given a much-needed boost to the economy. Infrastructure projects create jobs, stimulate local economies, and lay the groundwork for future growth. So there you have it. Consumer spending, business inventory spending, and state and local government spending on infrastructure. These are some of the key factors that have contributed to keeping the US economy afloat. How does the public view the economy's performance? Well, let's take a peek into the financial markets. You see, recently the Dow Jones Industrial Average closed above 38,000 for the first time ever, while the S&P 500 also reached a record high. These are both essential signs of economic health. And then there's the job market. Hiring in December was robust, surpassing expectations and suggesting a strong labor market. But how are consumers feeling? Is their sentiment reflecting this positive trend? A recent survey from the University of Michigan might give us some insight. In January, consumer confidence saw a surge, jumping by 13%, reaching its highest level since July 2021. This upswing in consumer sentiment is a promising sign for the health and trajectory of the economy. Despite some consumer frustration, the positive indicators and improved confidence suggest a hopeful outlook. What should we expect for the future of the US economy? A question that's both exciting and daunting. According to Lydia Bussour, a senior economist at EY, there's a roughly 35% chance of a recession on the horizon. The economy is expected to slow down in the coming months, and inflation, while falling, still remains above the Federal Reserve's target rate. This is where the Federal Reserve's role becomes pivotal. It's anticipated that they may cut interest rates later this year. Such a move could have significant impacts on the economy, as it would lower borrowing costs for both consumers and businesses. Imagine, lower interest on your car loan or mortgage, or businesses investing more in their growth. It could potentially trigger a burst of economic activity through increased household spending and company investment. While there are risks, measures are in place to mitigate them and potentially trigger further economic activity. Diversify your portfolio and follow G's Finance for more financial news.